Saving your first $100,000 is a massive milestone. Most people never reach it. It takes discipline, sacrifice, consistency, and patience. So first, if you've saved $100K, that's a big achievement. But now comes the more important question. What do you do next? Because here's the truth. The first $100,000 is about effort. The next millions are about strategy. If you simply let $100,000 sit in a regular savings account, inflation slowly eats away at its power. But if you position it correctly, this is where momentum starts working in your favor. Let's walk through the smart moves step by step. The first thing you need to do is separate safety from growth. Not all $100,000 should be invested aggressively. Before anything else, make sure you have a proper emergency fund, usually 3 to 6 months of living expenses. That money should stay in a high-yield savings account or money market fund. It's not there to grow fast. It's there to protect you from going backward. Once safety is handled, now we talk strategy. The biggest mistake people make after hitting 100K is getting overconfident. They start chasing risky investments, speculative stocks, crypto hype, or guaranteed high return opportunities. Remember this, wealth is built by compounding, not gambling. At $100,000, your focus should shift from saving to optimizing. Now your money can start working harder than you do. A simple and powerful approach is core portfolio investing. For many investors, this means allocating a large portion into low-cost index funds like an S&P 500 index fund or a total market fund. Why? Because these funds give you instant diversification across hundreds of companies. Instead of betting on one stock, you're investing in the overall economy. Historically, broad market index funds have averaged solid long-term returns over decades. Not every year, not every month, but over time, they've rewarded patient investors. Let's say you invest $80,000 into diversified index funds and earn an average of 8% annually. That's $8,000 in potential growth in 1 year, without adding a single extra dollar. That's when compounding starts to feel real. Now here's where things get powerful. At 100K invested, every percentage point matters more. A 10% return isn't just a number, it's $10,000. Your money begins to move in larger waves. The next smart move is tax optimization. If you haven't already, maximize tax-advantaged accounts. That includes 401ks, Roth IRAs, HSAs if eligible. The tax efficiency of these accounts can add tens of thousands of dollars over decades. At this stage, ignoring tax strategy becomes expensive. Now let's talk about income generation. Once you hit 100K, you can begin thinking about adding income-producing assets, dividend ETFs, REITs, or even building a small rental property fund. Not because dividends make you rich overnight, but because they create optionality. Income gives you flexibility. Growth builds net worth. Ideally, you want both. Another smart move at 100K is increasing your investment rate. The worst thing you can do is slow down. Many people relax after hitting 6 figures, but this is exactly when acceleration matters most. Because now you're combining new contributions with meaningful compounding. If you invest 100K and continue adding $1,000 per month, the growth curve becomes exponential over the next 10 to 20 years. Now let's talk about risk. Your risk tolerance may change at 100K. You might feel more protective. That's normal. But don't let fear push you into keeping everything in cash. Cash feels safe, but over long periods, it guarantees loss of purchasing power due to inflation. The key is balanced allocation, not extreme caution or extreme aggression. You should also start thinking long-term. At 100K, you are no longer just trying investing. You are building wealth. That means thinking in decades, not months. Avoid checking your portfolio daily. Avoid reacting emotionally to market drops. A 10% correction at 100K might feel scary. That's a $10,000 swing. But volatility is normal. Long-term discipline wins. Now here's something powerful. The first 100K is the hardest because your money isn't doing much of the work. You are. But after 100K, compounding becomes visible. At 8% average annual growth, 100K becomes roughly 200K in about 9 years. 200K becomes 400K in another 9 years. And the snowball keeps growing. This is why many investors say the first 100K is the breakthrough point. Another smart move is skill investment. At this stage, consider investing in yourself. That could mean business skills, certifications, networking, or building additional income streams. Increasing your earning power allows you to invest even more aggressively. Remember, investing isn't just about assets. It's about leverage. You should also review your asset allocation once a year. Rebalance if necessary. Keep your portfolio aligned with your long-term goals. And one more important point, protect what you've built. That means adequate insurance coverage, estate planning basics, and beneficiary designations on your accounts. As your wealth grows, protection becomes just as important as growth. Now let's summarize the smart moves after $100,000. Secure your emergency fund. Invest primarily in diversified index funds. Maximize tax-advantaged accounts. Consider adding income-producing assets. Keep contributing consistently. Think long-term. Protect your capital. The biggest danger after saving 100K is thinking you've made it. You haven't finished. You've started. This is where real wealth building begins. If you stay consistent, avoid emotional mistakes, and let compounding work for the next 10 to 20 years, your first $100,000 could turn into financial independence. Because wealth isn't built in one dramatic move. It's built through patience, strategy, and time. So if you've saved $100,000, don't celebrate by slowing down. Celebrate by positioning it correctly. And let your money start working harder than you ever could.